Hey everyone, and welcome back to the channel. Today, we are re-tackling a topic that you hear about all the time in the news, but might not fully understand. The 10-year U.S. Treasury yield. What is it, and why does every investor, economist, and news anchor seem so obsessed with it? Stick around, because by the end of this video, LLC. Why this single number is one of the most important metrics in the entire global economy. So, let's start with the basics. What exactly is a 10-year U.S. Treasury bond? Think of it like this. When the U.S. government needs to borrow money to fund its operations, everything from building roads to paying for national defense, it issues bonds. When you buy a Treasury bond, you are essentially lending money to the U.S. government. The 10-year part simply means the loan has a term of 10 years. In return for your loan, the government promises to pay you interest, typically twice a year, and then return your initial investment, the principal. When the 10 years are up, the interest rate on this loan is what we call the yield. So, the 10-year Treasury yield is the annual return an investor gets for lending money to the U.S. government for a decade. Now, you might be thinking, okay, that sounds simple enough, but why is it such a big deal? Great question. The 10-year Treasury yield is considered the benchmark for interest rates worldwide. Why? Because lending to the U.S. government is seen as one of the safest investments on the planet. The chances of the U.S. government defaulting on its debt are incredibly low. Because of this rock-solid safety, the yield on its bonds sets the risk-free rate of return. All other investments, which carry more risk, are priced relative to this benchmark. This has a huge ripple effect across the entire economy. For instance, the interest rates you pay on your mortgage are directly linked to the 10-year Treasury yield. When the yield goes up, banks and lenders have to pay more for their money, so they pass that cost on to you in the form of higher mortgage rates. The same goes for car loans, student loans, and credit card rates. It also affects businesses. When companies want to borrow money to expand, build a new factory, or hire more people, the interest rate they get on their corporate bonds is often based on the Treasury yield plus a little extra to account for their higher risk. So, a rising 10-year yield can make it more expensive for businesses to grow, which can slow down the whole economy. But there is another fascinating layer to this. The relationship between a bond's price and its yield. They have an inverse relationship, meaning when one goes up, the other goes down. Imagine a bond is issued with a fixed interest payment. If demand for that bond suddenly skyrockets, maybe because investors are nervous and seeking safety, they bid up the price of the bond. But since the interest payment is fixed, your effective return or yield on that higher price is now lower. Conversely, if investors start selling off bonds, the price drops. A lower price for the same fixed interest payment means your yield is higher. This dynamic is a powerful tool for gauging market sentiment. When investors are feeling optimistic about the economy, they might sell safe bonds to buy riskier assets like stocks, causing bond prices to fall and yields to rise. When they're fearful, they flock to the safety of Treasury bonds, pushing prices up and yields down. So, what do the recent trends in the 10-year yield tell us? Lately, we've seen a lot of volatility and a general upward trend in yields. There are several reasons for this. One of the biggest drivers is inflation. When investors expect inflation to be high, they demand a higher yield on their bonds to compensate for the fact that their future interest payments will be worth less in terms of purchasing power. Another factor is the Federal Reserve's policy. When the Fed raises its key interest rate to combat inflation, it tends to pull Treasury yields up with it. The sheer amount of government borrowing also plays a role. If the government needs to issue a ton of new bonds to cover its spending, this increase in supply can push prices down and yields up. By watching these movements, we get clues about where the economy might be headed. A rapidly rising yield could signal strong economic growth and inflation ahead, while a falling yield might suggest a slowdown or even a recession. To wrap it all up, the 10-year U.S. Treasury yield is far more than just a boring number for finance geeks. It's a fundamental pillar of our financial system. It acts as the economy's pulse, reflecting investor confidence, inflation, expectations, and future growth prospects. It directly influences the cost of borrowing for everyone, from homeowners to massive corporations. By understanding how it works and what its movements signify, you're not just learning about bonds. You're regaining a much deeper insight into the powerful forces that shape our economy and your own financial life. I hope this helped demystify the 10-year Treasury yield. If you found this video helpful, please give it a thumbs up. And don't forget to subscribe for more content that makes complex financial topics easy to understand. Thanks for watching, and I'll see you in the next one.